Welcome back to AlgoBot, where we break down automated trading strategies for MetaTrader 5 purely for education. I'm your host, and in today's deep dive, we explore an expert advisor called Adaptive Transition Matrix Bias. This is a strategy built entirely from first principles. It uses no classic chart patterns and no support or resistance. Instead, it turns each finished candle into a simple symbol, and then learns how those symbols tend to follow one another. Stay with me, and you'll see exactly how it reads the market, how it opens and manages positions, and how the code works, line by line. Let's start with the big picture. Adaptive Transition Matrix Bias is an expert advisor for MetaTrader 5 that treats the market as a stream of simple symbols, rather than a chart of patterns. Every time a candle closes, the strategy reduces it to one of three states: up, down, or flat. Up means the candle's body closed clearly higher than it opened. Down means it closed clearly lower. Flat means the move was too small to matter, judged against a dead zone that is scaled by the average true range. Importantly, the average true range here is only a neutral yardstick for volatility. It is never a signal by itself. Once the market is a stream of these symbols, the strategy asks a statistical question. Given the state of the current bar, what is the next bar likely to be? To answer it, the expert advisor maintains a small three-state Markov chain, a grid of recency-weighted counts that records how often each state has been followed by each other state. It updates online, with exponential forgetting, so it constantly adapts to the most recent behavior and lets stale structure fade away. From that grid, it reads a single directional edge for the next bar, and it only acts when that edge is statistically strong enough to stand apart from random noise. The strategy was designed with liquid currency majors in mind, such as the euro against the US dollar, on intraday timeframes like 15 minutes or 1 hour, though the code itself locks to no particular timeframe. This approach will appeal most to traders who are curious about quantitative and probability-based methods, and who want to understand how a self-learning model can be built without a single traditional indicator overlay. As always, trading carries risk, and losses are a normal part of the process. So how does the expert advisor actually make each decision? It all happens once per completed candle, and it only ever uses finished bars, so there is no peeking into the future. The first step is classification. The strategy takes the just closed candle and measures its body, the close minus the open. It compares that body against a dead zone whose width is a small multiple of the average true range, controlled by the flat zone parameter. If the body is larger than the dead zone, the bar is labeled up. If it is more negative than the dead zone, it is labeled down. Anything in between counts as flat, meaning no meaningful effort in either direction. The second step is learning. The strategy keeps a 3x3 grid of transition counts, one row for each current state and one column for each next state. On every new bar, it first multiplies the whole grid by the forgetting factor, Lambda, which is set to 0.97 by default. That gentle decay lets old structure fade, so the model tracks the current regime. It then adds 1 to the cell for the transition that just occurred from the previous state to the current one. The third step is forecasting. From the row of the current state, the strategy reads how often that state was followed by an up bar and how often by a down bar. The difference between those two probabilities is the directional edge. Because this edge is estimated from a limited sample, the strategy also computes its standard error and requires the edge to clear a band of Z standard errors, where Z is the significance parameter. It also requires a minimum number of observed transitions before it will act at all. When there are few observations, a large edge is demanded. Once many consistent transitions pile up, a smaller edge is enough. The fourth step is trading. If the edge clears the upper band, the strategy opens a long. If it clears the lower band, it opens a short. On entry, the stop loss is placed at a multiple of the average true range away from price, and the take profit at a larger multiple, using the stop and target parameters. A trailing stop then follows the trade, ratcheting only in its favor. And if a significant edge appears in the opposite direction while a trade is open, the strategy closes that position early, reading the reversal as a change of regime. Only one position is held at a time. Let's read the core of the strategy the way you'd see it in MetaEditor. At the top are the input parameters. Lambda is the forgetting factor that decays the transition grid. flat zone controls the width of the dead zone as a fraction of the average true range. SignificanceZ sets how many standard errors the edge must clear, and minimum transitions sets how much evidence is required before any trade. Then come the risk settings: the average true range period, the stop multiple, the target multiple, the trailing multiple, the lot size, and the magic number. In the middle block, you can see the decision itself. The code takes the probability of an up bar and the probability of a down bar out of the current state and subtracts one from the other to get the edge. It then computes the variance and the standard error of that difference and builds a band by multiplying the standard error by the significance parameter. The long signal is simply true when the edge is greater than the band, and the short signal is true when the edge is less than the negative of the band. At the bottom are both entry functions. In interlong, the code reads the ask price, places the stop loss the stop multiple of the average true range below it, and the take profit the target multiple above it, then calls trade.buy. Enter short mirrors this exactly. It reads the bid price, places the stop multiple above, the take profit the target multiple below, and calls trade.sell. Both sides are fully symmetric, so the strategy treats longs and shorts with the very same logic. Let's bring the whole idea to life on a chart. Across the top, you can see a sequence of candles on a currency major, and below them a subpanel plots the strategy's own custom oscillator, the directional edge. That edge is simply the probability of an up bar minus the probability of a down bar, as forecast by the learning matrix out of the current state. It swings between -1 and +1, and the two dashed lines mark the self-adapting significance bands. When the edge pushes above the upper band, the chain is leaning up. When it drops below the lower band, the chain is leaning down. Look at the first two candles on the left. Both close lower than they open, so the strategy labels them as down bars, and the edge in the panel sits deep in negative territory. There is no long signal here, because the recent transitions have been biased downward, and the edge has not yet cleared any upper band. Now watch the third candle. It closes higher than it opens, the first up bar after a run of down bars. That single transition begins to lift the edge. On the next candle, the accumulated up transitions push the directional edge decisively above the upper significance band. This is where the buy entry marker appears. The strategy has detected that, out of the current state, the next bar is statistically biased to the upside, and the departure from a pure coin flip is large enough to clear the band. The expert advisor opens a long position at the following bars open. From here, price begins to climb. Each new candle prints a higher close. The up bars keep confirming the forecast, and the edge stays comfortably in long bias territory. As price advances, the average true range trailing stop quietly ratchets upward behind the move, keeping the stop closer to price while it only ever shifts in the trade's favor. Several candles later, price reaches the take profit level, set at 3 times the average true range above the entry, while the stop sat 2 times the average true range below it, giving a reward to risk of 3-2 on the planned trade. The long position closes at its take profit marker. Now the character of the market changes. The next candle closes lower than it opens, a down bar right after a strong run higher. The directional edge rolls over quickly, sliding back toward the middle and then lower, as fresh down transitions replace the older up ones, thanks to the exponential forgetting inside the matrix. On the following candle, the edge falls below the lower significance band. That is the sell entry marker. The chain out of the current state is now biased to the downside, and the edge is far enough below zero to be counted as meaningful rather than noise. The expert advisor opens a short position at the next bar's open. Price then works its way down, candle by candle, each one closing beneath the last, confirming the downward bias. Again, the trailing stop follows along above price, tightening as the move extends. A couple of candles later, price reaches the lower take profit level, once more placed at 3 times the average true range from the entry. The short position closes at its take profit marker. Notice what tied both trades together. The strategy never looked at a chart pattern or a fixed price line. It simply watched how one bar's symbol tended to be followed by the next, measured whether that tendency was statistically real, and acted only when the evidence cleared its self-adjusting band. And if the edge had flipped hard against an open position, the adaptive exit would have closed it early, before the fixed stop, because a genuine change of regime had been detected. That is the full loop, from raw candles to a gated, self-correcting decision. That brings us to the end of our breakdown of adaptive transition matrix bias. We saw how the strategy turns every finished candle into a simple up, down, or flat symbol, how it learns a recency-weighted transition matrix with exponential forgetting, and how it only acts when the directional edge clears its own self-adapting significance band. We walk through both a long and a short example, and we read the key parts of the code together. Remember, everything in this video is educational information only, and nothing here is financial advice, a recommendation, or a solicitation to trade. If you found this useful, please like the video, subscribe for more MetaTrader 5 strategy breakdowns, and leave a comment telling us which strategy we should analyze next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.